Hello, I'm James Grigger, joined by Stefan Clark of NZ Funds, and this is a conversation on the New Zealand economy, geopolitics, and the tough calls shaping interest rates right now. Jarrod Kerr, chief economist at Kiwibank, has stepped right into the middle of that divide and hasn't held back, calling near-term hike forecasts reckless. So, what happens when consensus breaks down, if that was even consensus prior to that, and when markets, policymakers, and economists are reading the same data? How do we reach such different conclusions? And so, we're really pleased to have Jarrod Kerr from Kiwibank on the podcast for, I don't know, the fifth time or something like that. Starting to be a segment that we really enjoy doing. And so, Jarrod, thanks for taking the time. Appreciate you coming on this morning.
Kia ora, good morning. Thanks for having me back.
So, Jared, I think we'll kick off right into the middle of the foray that was in the New Zealand business landscape last week, which was interest rates and the view around should they be hiking because of inflation pressures from high oil prices or not. But do you want to maybe take a step back,
With the
like you're good
breakfast
at doing, and just giving us maybe setting the
is
scene of what's gone on this year and
so
perhaps how we got to the
that
stage that we did last week when consensus is perhaps different across different economists in New Zealand.
So the war in Iran has thrown up all sorts of complications to the economic outlook. And, the simple way of looking at it is it has been a supply shock. We can't get oil out of the strait. A lot of that oil goes into Asia, countries like South Korea, Japan, even China. The majority of the oil that they consume comes through that strait. So this is really an Asian problem. Not a lot goes up into Europe. So we're having to see, countries like Singapore, South Korea, and others actually trying to get oil from other parts of the world. But the price of oil today is $90 a barrel. That's not that high. If you looked at it and sort of realized the threat, oil should be at like 130, $140 a barrel, but we keep hearing, there's a ceasefire, there's going to be some sort of conclusion here. We just don't see that happening in the near term. We see things rumbling along for a while. So you bring that back to NZ. Obviously, we've got a higher petrol price. More importantly, we've got a even higher diesel price because the oil that comes out of that strait is used more in diesel than anything else. So we've seen this massive shock in diesel. And we've all just suddenly realized that very large parts of our economy run on diesel. So if you're a farmer, most of your machinery is diesel. If you're picking fruit, a lot of what you do requires diesel. And then there's obviously, the main freights of this world who you know s- send things up and down country using diesel. So our diesel supply has really come into focus. We seem to have quite a bit, but there's just that niggling risk that maybe that supply dries up and we end up with a shortage, and that could be quite catastrophic. It would make COVID look like a good period. So there is that niggling risk there. I don't think we go down that path. I think we make our way through. But people are then saying, okay, so what does that mean? Well, if we've had this supply shock, the price of diesel's gone up, that shows up in our inflation reports. And then you have a debate between economists. Well, is that temporary? So it goes up, comes back down, and away we go. Or does it cause second round effects? And the second round effects really driven by how strong the economy is and how strong demand is. So we are saying this is just purely a supply shock, and demand's actually quite weak. This is not COVID, where we were locked up, didn't spend any money, came out with a bunch of savings and just sprayed. This is not COVID, where the cash rate's at just 0.25% and house prices then leapt 45% in a few months. No, it's not. We are not coming out of this with a massive surge in demand. In fact, the customers that we've spoken to, they're struggling to pass these costs on. We're hearing of jobs being cancelled. We're hearing of construction guys not turning up to the site because they're not going to get the price they need to do the work. So we're actually seeing quite an impact on demand in that most economists are all revising their growth forecast down. So I got no idea how you do that and then expect rate hikes in July. It is counterproductive. It is going to hurt our economy that was already struggling to recover before the Iran war.
So when you think about the mandate of a central bank, uh, when they think about inflation, do what inflation are they looking? Are they looking at headline inflation, or I was always of the understanding that they look through headline inflation and look at core inflation. What um, and when you look at core inflation, actually energy prices don't make up much of that core inflation number. The other thing I meant to say is I always get, because I've lived in both countries often, I always get confused which central bank looks looks at what number. So this could be a UK centric thing. But also there's that aspect. But then also going back to university days, and this is really going back a long way, but it was always I was always of the understanding that from a as you mentioned, this is a supply side issue, and when it's a supply side issue, that's a fiscal thing, and when it's a demand side, when it's a demand side issue, that's when monetary policy comes in. So if we were spending up large and the economy was booming and we were all sort of out there, like you said, like during COVID, spraying money around, that's when central banks need to cool the economy a bit. But when it's uh, uh, a supply side shock, but there's not really anything monetary policy can do about that. So they sort of step out. Do you think that's the kind of thing our central bank would be looking at?
That is exactly right. Everything you said, exactly right. So it's a supply thing. There's nothing they can do with it. They can't go out there and lift or reduce the price of diesel. Right, that's priced offshore. So there's a lot of things that central banks do. They target inflation, as you say. So our central bank targets inflation between 1% and 3% over the medium term, and they really want that 2% midpoint. And the reason they use that 2% midpoint is a behavioral thing. If they tell you that they're targeting 2% and they tell you to expect 2%, people actually start expecting 2%. And even though there's fluctuations in the short term, over the medium term, hopefully inflation expectations are still kind of anchored at 2%, because that does a lot of their job for them. Telling people, hey, 2%, 2%, 2%, when you're in your negotiations in the real world, and you have, inflation spiking to say 4.5%, which is probably what we're going to see here, people will still have in the back of their minds that things are going to, normalize and go back to two. That's important. Now, what they look at on the inflation front, they obviously look at headlines, see what that's doing. Well, headlines going to spike because of the diesel and petrol price. It's the core measures that are more important, and core measures give you a better read of inflation over the medium term. You strip out food, energy, rates, a whole bunch of stuff that have gone up over the last couple of years, and inflation's running at about 2.5%. So it's on the high side, but it's not outside the RBNZ's band. And if you look at some of the larger drivers of inflation, like rents, really weak, really weak. Our housing market's been, weak for 3 or 4 years. Basically, house prices going sideways, a lot of supply coming to the market, rents are running, sub 3%. And then you look at wages, which is obviously the largest part of many businesses' costs, and wage inflation's at 2%. So really soft labour market, unemployment rate that's been rising, underemployment rate that's been rising even more, up at 13%. There's a lot of slack in the economy. If core inflation was higher and looks like it was hitting higher, then I get it, and we'd be there saying, well, they've got to tackle inflation. They have to do the hard thing and tighten. Hopefully, tomorrow's data that we get comes out and shows core inflation is still, within the RBNZ band, And as soon as that prints tomorrow, we're going to go out and say, look, the Reserve Bank's got time. They've got time. They don't have to knee jerk react to a supply side shock.
So when you look at, I don't want you to, you don't, or you can, of course you can, but I'm not asking you to comment on how other people think about these things. But why? How would you come to the conclusion that rates need to go up?
Because you're worried about inflation and inflation only. You're sitting there looking at headline, going from an annoying, not uncomfortable, an annoying 3.1% where we are now. That headline rate might come off a little bit tomorrow, but it's all about the next read where we're all sort of anticipating that diesel price to feed through into CPI. And you could get an inflation rate. The Reserve Bank thinks it's 4.2, but it could be a little higher. But the fact that the oil price is back at $90, some of that's coming out, it could be temporary. Um, and I guess the difference between us and others is they are looking at it, I think, too mechanically, saying inflation is doing this, that's going to feed through to inflation expectations. Yes, obviously, and it's going to be quite sticky. And I'm like, well, I don't get the sticky bit. I don't see it, with such a soft economy and without that surge in demand. And in fact, we are all forecasting a reduction in demand, a contraction in the current quarter. Why are you adding to businesses' costs at a time when they're in a cost of living crisis? Why are you slapping households with a higher interest expense when they're struggling to pay their petrol bill?
Yeah, we did a bit of research on oil shocks over the past, I guess since oil was a massive input in the 1920s, and it seemed to us the research we did was every oil shock we've had, and when we get a substantial uplift in oil prices, interest rates end up coming down within the next six to 7 months. So not even held, but come down because of the pressure it's putting on the economy.
It's a tax, isn't it? And, you do need people like you going back and looking at this stuff because it's important. When I was at university, they told me that, a rise in petrol prices acts like a tax on consumers. What does that mean? Well, the $100 that you had to go towards your travel costs, doesn't go as far as it did a few months back. The money that you've got in your back pocket is kind of evaporating. So the discretionary spending gets cut. You ask anyone who owns a petrol station, they will tell you when you see a spike in petrol prices like we've seen now, customers react immediately. So prior to the spike, they'd fill up their tank, they'd walk in, they'd say, "Good morning, can I have a coffee and a muffin?" And maybe, something else, and then walk out. Whereas now they walk in, pay for their petrol, walk out, don't even say hello. That's the difference. So you see it immediately that they stop spending on the discretionary coffee and muffin. That's happening throughout the economy. So if we're all struggling to spend, if we're all struggling to pay for, it's not just petrol, it's food, it's a whole bunch of things that have gone up. We've seen, spending on clothing and footwear, for example, declining for basically 3 years. It's like people are having to cut back on stuff. Yeah.
When you think about, I know this is a hard thing to do when we say, okay, we'll take the oil price out of it for a second, but if we do manage to push through a um, some sort of resolution in between the Iranians and the US, and oil prices aren't going to drop significantly instantly, but we might get some relief, yeah, through the rest of the year. If if we assume that for a second, how are you thinking about the New Zealand economy? How was it recovering prior to this happening, and were we seeing some green shoots, or was it still quite a difficult time? Set us up for, I guess, best case scenario, and then obviously we can overlay and all think for ourselves what it means for the worst case if oil prices stay really high. But how are you thinking about things at the moment from a wider economic perspective?
We sort of, came into this year with a real spring, in our step. It sort of felt a little bit like the start of 2025, where we sort of came in and said, "Okay, things are gonna get better." We fell back to recession, so we've had basically recession for a couple of years now. We came into this year even more upbeat because we finally had the reaction from the Reserve Bank that we've been demanding for, a few years. We were saying, "You've got to get the cash rate down to 2.5. You've got to cut below 3 in order to help stimulate this economy." Well, it took them too long to do that, and they ended up having to go to 2.25. And then there was some miscommunication, so that bottom in in our interest rates lasted for, like, 2 weeks, and then we're going the other way. Anyway, we came into this year saying, "Well, hey, look, at least interest rates are at a level that are not inhibiting, the economy, and theoretically, they should be, stimulating a little bit." So we came in here thinking, "This is it." Businesses were a lot more upbeat coming into this year. Real estate agents were more upbeat because there was more activity. Things were just happening, right? Finally, things were happening, and then once again, we get hit with, a shock that's kind of derailed that. A lot of businesses were pointing to the election as an issue for them. They thought that there would be a change in government. They thought that that would mean there's a capital gains tax and other stuff. So there was this sort of, niggling feeling that the election was going to play a role this year. It's just been all of that's just been sideswiped, by the war, in Iran, and I think, over the next 6 months, we'll get laser focused on the election, and businesses are worried that a potential change in government would mean, a whole lot more taxes. Whether that's actually the case or not doesn't matter. It's their perception.
Yeah, perception causes slower speeding up into an election, and so you sort of don't get that recovery that you're hoping for.
Do you, Jared, do you think that, I mean, this torpedo came in really quickly, and then suddenly it was a supply shock, and prices obviously escalated, and then the economy's responded. If it gets resolved, will it go the other way? Will confidence come back with the same pace? And
Uh,
then we go back to where we were earlier in the year, that sort of moment in time when there was green shoots were being felt everywhere, so to speak, and you could feel the economy was indeed turning.
yeah, I mean, we certainly hope so. That's kind of, that best case scenario. Things get resolved, the oil price settles wherever it settles, petrol, diesel. We're not going. I don't think we're going all the way back, but we will definitely come, uh, back down, and just with that weight off the shoulders of many businesses, they'll hopefully, start looking to next year. I hate to say it, but they'll start looking to next year, as the recovery. Right, you've got whatever happens, in Wellington on the political side, and then I think we'll be looking to next year, with a spring in our step again. So that's definitely the best case scenario, what we're kind of hoping for, as well. And you just look at markets. I mean, markets. It amazes me that the S&P in the US is, you know performing the way it's performing. It's just shrugged this off, to some extent. And the fact that we're talking about rate hikes and not rate cuts, I think is quite telling, right? The market's just kinda looking through this.
Yeah, you can't, the market is telling you exactly what it wants to, and you have to listen to it, but I think it's one of those things that in the end, if oil prices and gas prices, or gas meaning petrol prices, stay high, you gotta think that growth rates and interest rates have to come down. But I get industries that aren't affected by it, like AI and those sorts of things, so their earnings growth still stays pretty strong. I was listening to the amazing stat around Anthropic the other day, where their revenue was 0 in 2023, and now it's 30 billion a year run rate. I mean, that's a that is mind-boggling. And,
Incredible, isn't it?
about oil prices, that's for sure.
Incredible. Yeah.
Do
Me
you when you look at it, are there particular, I guess, parts of the New Zealand economy that, or like even asset classes that you think, hey, this is somewhere we should pay more attention to? They can shrug this off in the same way that that Anthropic can, obviously not to the same extent, being a behemoth that it is. But are there parts of New Zealand that you think actually this isn't this has actually no bearing on it, or it's actually a positive?
Um, uh, I th I think it's difficult actually. I think our greatest strengths, like if we look at the New Zealand economy as a whole, our greatest strengths are also our greatest weaknesses here. Um, so, that agri sector that's been doing uh, so well, could be really hurt by a supply disruption here. Our tourism industry that's been doing so well, like just got back to pre-COVID levels of tourism, was fantastic. Queenstown was happy. The rest of the country was looking for tourists to just keep rolling in. Next minute, it's not just airfare spikes and the ticket prices, actual cuts in flights. So we're physically not going to get the number of tourists that we want. So those are our two biggest strengths. You look at the manufacturing sector that we do so well in, and send a lot of stuff to Australia. There's risk there as well. If all this gets resolved, those three will just, hopefully take off again, and that's the New Zealand economy humming. That's the New Zealand economy humming, and we need that because, like most developed economies, it is your consumer that drives demand, and to get wages going again, to get those, unemployment rates, underutilization rates, to get those heading south, and getting that consumer back on their feet again. That's key for me. Sure, there's a few parts of the economy here and there that we can kind of think of, but we're only tinkering with very small bits. That really is getting services back up and running, and a lot of it just comes back to how are households performing, and they're not performing well now because they've been hurt. But look, in 6 months' time, there might be a spring in people's step again. Might be spending again, and that's the key for me.
So I wanna do a scenario, Jared, and let's pretend and it doesn't matter what side of the aisle they're on. The new government's just been announced and voted in, and whenever it is November, and you've been asked to come in as the Kiwibank economist to go advise the new minister or current minister of finance on what now. Or gas prices still high. Um, you know, do we subsidize petrol prices? How do we get the economy going? And what's our long-term strategic plan? Which industries should be focused on to grow? If you must have like a list of things that you just want to get in front of. Just do these
Finally, I've
things.
been asked
Come
for
on,
this.
yeah,
Yeah,
let's
yeah, yeah, yeah.
hit us with it. What would you do?
You know what? I would say to what I've said to these people over the last 20 years, and that is austerity doesn't work. We've seen it in Europe. We've seen it in large parts of the globe. Austerity doesn't work. Sitting there counting pennies, refusing to invest in the infrastructure that the economy needs because it's too hard, and you get voted out on that sort of stuff. It's just it's saddening how we just keep falling behind because we just can't seem to get together on the stuff that matters, and that is infrastructure in this country. So all these economists turn around and say we've got this infrastructure deficit. What does it mean? Well, it means we haven't spent enough on our roads, rail, our sewage systems, our everything to keep up with the population growth that we've had over the last 20, 30 years. We simply haven't built what we need for the future. So when people say that productivity is low in New Zealand, you'll hear a lot of arguments as to why that is and how to get out of it. You know what? It's infrastructure for me. That's been our greatest, handbrake. That just seems to be firmly on. It's really difficult for a government to come out and say, right, let's you know increase our debt in order to build the infrastructure, because it's a hard sell. And I don't know why it's a hard sell, but it is a hard sell for the New Zealand public, because we've all been taught that an increase in debt just means, we're going to be in more trouble. There's good debt and there's bad debt. Um, when a government like the governments today tell you that they are leaving headroom for the future on the amount of debt that we've got, they're telling you that their revenue is not going to keep up with their costs. They're telling you that we need to take on bad debt over the next 20, 30 years, with an aging population that we refuse to deal with. That's bad debt. That is bad. If that was a business and they were telling you our revenue is doing this for the next 20 years and our costs are doing this, so we need to take on debt over the next 20 years because of that. Would you drop that stock? You would drop that stock in a heartbeat. You would force that business into bankruptcy. Um, why are we doing it? I don't get it. So the thing is that how we could tackle it is spending more today on infrastructure. And then what does that do? Well, it makes our economy harder, faster, more resilient tomorrow. Well, why is that a good thing? Well, the economy is your tax base. If your tax base is increasing, then you know your revenue as a government is increasing. So you spend a dollar today on quality infrastructure and you deliver it. That's the hard part. Then you get $1.50, $2 down the track for what you've done. That's that kind of fiscal multiplier thing
Well,
that
that
we
requires you to
talk
think
about,
more than 3 years ahead.
which you
So,
can't do. You're not
yeah,
allowed to do that.
yeah.
So
No.
what happens then? You mentioned yeah, this is all by because I think we're all on the same page here, but I'll keep going with it anyway. It'd be great if you said something controversial that I could disagree with, but
I was gonna throw a bomb out and be like, argue the case for the other side. That
Yeah.
or
We don't trust future governments.
yeah.
We don't trust future governments to rein in and balance the books. We don't trust the ability, if we take on, say, 10% of debt, we don't think that that 10% is going to be spent wisely and deliver what we need. That's the nuts and bolts of the other side of that argument, and it really, really saddens me that's our mindset. I don't trust the next government. The next government's going to potentially be there in 3 years.
and yet red and blue are like basically the same thing with a few slightly different colors and a few different, but in terms of political spectrum, they are both very close to the middle. So it's
And
funny
the
that
New Zealand public's being trained to be petrified of governments coming up with big ideas. The last one was, let's build 100,000 affordable homes. Do you know what? Brilliant. Absolutely what we needed. There's an affordability issue here. If you had a government coming out and saying, we're going to build 100,000 homes and we're going to get the private sector together, make sure those 100,000 homes are built and, they're priced at a reasonable level, or it includes social housing. I don't know, whatever. We needed 100,000 homes. Really, really unfortunate that they only delivered a couple of thousand, I think, in the end. And that is the government's biggest fear. You come out with big policies, which I completely agreed with, but you just can't seem to deliver, and then people will just mock you and remind you of your failure from that point on. So the next government comes in, are they going to tackle 100,000 homes? Absolutely not. It's in the too hard basket. Do we need it? Yeah, of course. We've got a shortage of quality housing, particularly in that sort of under $1 million bracket. We're really, really good at building a $5 million home. We can do those really well. Cannot cannot seem to build a 500 to 700,000 home.
Do you know that line that you just used is exactly the issue with the pension and retirement savings as well. We are good as an industry, the New Zealand financial industry, of managing people's money if they have 5 million. We're good at that. We can grow that capital. The issue we have is accumulating capital for people that don't have a lump sum, and we're reliant on this pension. And that goes back to your previous point: is all we're doing is increasing our debt to pay more and more state pension as we have an aging population, and those debt levels increase. Meanwhile, we're not good at teaching our people to accumulate wealth. And KiwiSaver's a start, but it's only a tiny part of the big picture. And um, it's the aging population is hurting a lot of Western countries. Look what's happening in the UK, that they're going through the exact same issue of huge increases in pensions, where they've got the triple lock. The pension has to increase every year, no matter what, because that's the voter base.
Yeah, yeah, I agree completely. You know, you look at what does an aging population mean? Obviously, you just said more pensions are being paid for, with fewer people underneath, paying tax to cover that. And then there's the increased health costs. There's the increased costs to our society that we're just not growing into, and we're just not addressing. I think we will be forced to lift the retirement age. I just, I'm coming on 50 years old, and there's no way the retirement age is going to be 65. When I get there, they'll increase it to 67, and then they'll increase it to 70. And by the time I get there, I think they'll let me retire in my next life.
And that's the thing. If you
You need to speak to a financial advisor.
Yeah, yeah. You guys got some time?
hey, I don't segue.
I want to go back just to the original inflation topic. So, what we obviously think quite carefully about how we position portfolios. We have a slightly like you, non-consensus view on the direction of things. And there'll be a lot of people who are invested, whether they're investing with us or investing with other providers who hold bonds, for example, or bond-like instruments, infrastructure assets, and so forth, gentailers perhaps. And I'm thinking about, well, what should my portfolio be set up for? And right now, I guess your core thesis is that long dated bonds should be coming down, right? The rate should be coming down. It's too high.
Yeah,
And
we'd definitely be long duration in our bond portfolios, and that is basically what these people behind me. We have discussions every day about what interest rates are doing and how the bank needs to think about interest rates. Obviously, a massive thing for banks is dealing with interest rates. That's our thing. That's our life. We love it. So obviously there needs to be in any portfolio at any point in time, there needs to be a fixed income bond component to it, because when things hit the fan, bonds just rally hard. So their bonds perform really well in bad times, as your equities might be doing something else. So we look at Kiwi rates, and we look at a 2 year either bond rate or swap rate. It's over 340, close to 350. And we have a cash rate of 2.25. So we look at that and go, you know what? There's a lot priced in there. The fixed income market in New Zealand is pricing in 3 rate hikes this year. So basically, ANZ's view is bang on in the market. That's exactly what's priced. It's 100 basis points priced over the next year. That to me is way too much. I mean, you are hitting an economy hard that doesn't need it. So, our position as economists, but also as a bank, is kind of hinting what you're saying is that we think we would be we are long duration at the moment. We're receiving those high fixed rates, thinking that they're going to come down because there's too many rate hikes priced in to the curve. Um, yeah,
yeah, well, for us, and obviously we're building diversified portfolios for investors with different, long-term goals, but how you set that up for a family, what the right setup is. Um, it's a real. These moments are a good opportunity to reflect on it, to review it, to consider it, and go, okay, hey, have I got the setup that's right for me and my family? And because it's unfortunately, whether you like it or not, you're basically taking a directional view. It's quite a good idea to have confidence that you're heading in the right direction.
Yeah, we all need we all need financial advice. We all need someone like yourself to sit there and say, it's very tempting to do exciting things and punting all your money on AI stocks or Bitcoin or whatever the flavor of the month is, but sort of sitting back and saying, actually, everyone tells you need something called diversification. Everyone tells you that you need, is it a 60-40? Sometimes that works, sometimes that doesn't, but that's generally been the theory: 60% equities and 40% bonds or something like that. Look, it's up. You guys are better at this than me. Um, my job is to say, the economy does this. Uh, we've 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 gone through quite a downturn, like I think quite a bad downturn. If you look at the performance of our economy in the last couple of years, was worse. It's worse than the GFC. I just
Nuts,
really
isn't it?
struggle with that.
Yeah.
It is nuts. It's crazy because the GFC for me was my crisis. Like
Yeah.
I was bang
Still,
in there, loving it, right, and up to my eyeballs in pure madness. It lasted quite a long time. This has just been really disappointing, and it has been really bad for small to medium sized businesses, and it's been really tough for Kiwi households. And it's not a 6 month contraction. We're talking 2, 3 years of really difficult cost of living pressures. So, in times like this, it frustrates me because people who I'm very close to, they um they see, oh, a war in Iran, I've got to take all my money out of the pro growth strategies and put it all in cash. And it's like by the time you've done that, the market's rebounded. It frustrates me every time. You need more of a long term strategy. I think when it comes to your nest egg, developing your nest egg for retirement, then I don't think this kind of in out bounce around strategies that work.
well, you can look at the S&P 500, and I mean, it would you would have to be a very enlightened person to say 2 weeks ago that, or 3 weeks ago, that you're going to be hitting new highs today. Obviously,
Yeah,
as investors, we're positioned very carefully for both sides. Because we didn't. I think it's fair to say, James, we want to participate in the process, and we're really confident in the companies that we hold for the future, and we're long-term investors. But there are definitely individuals out there who want to move very quickly, and it doesn't always serve them, or don't move. They sit on the sidelines when it's in their interests to progressively invest bit by bit. They go to conservative in their contributions or whatever it happens to be. So
Mhm.
Hey, Jared, last thing I wanted to ask you is if we go back to the beginning of this conversation about rates and your counter consensus view, what is the catalyst that we need to see over the next few weeks and maybe months that will lead, I guess, the market to become, in your view, our view, should I say, to become consensus? Are there certain data points that we need to look at, or is it just a feel across a lot of different things?
I think it is a feel across a lot of different things, but there would be data points within that stand out more than others. The inflation report tomorrow is quite important for me, just to
And
give us that
what
starting
information would
point.
that be to? Like, what's that from? Is that first quarter or?
Yeah, yeah, first quarter. And the December quarter finished with a headline rate of 3.1, and a core rate, I think, is 2.5 to 2.8, depending on which things you were looking at. I would love it to come out at 3.1 again, which is our forecast. So the annual rate just stays the same. But then I'd love to see that core rate just kind of continue continue south, just to give the Reserve Bank some feeling of headroom to start with. So it's an important one, but then all the data points that come out between now and July, we'll get another, GDP report. We'll get another QSBO survey tomorrow. We get another, a whole bunch of stuff. What we don't want is signs of businesses profiteering and passing on, more than the cost that they're incurring. There are people looking out for that. We certainly haven't seen it. We've seen
That's that
the actually obstacles.
stopping buying muffin type of analogy, isn't it?
Yeah.
Yeah.
Yeah. So a lot, and I guess our argument against the July rate hike call is that you just haven't seen enough data to justify raising rates by July. I think, you need to see the second quarter CPI data, and we haven't even finished the quarter yet. And that'll show you just how much hit. But then we would also argue, well, you need to see the third quarter inflation to see if it did this.
Yeah, the one-off and then the flat again.
Yeah. Is that the case? Did that happen? So for me, the earliest rate rise is December. And another reason it's December is because it is after the election. Why would you, um, interfere if you if you don't have to? You know what I mean? So 3 rate rises into an election is going to be very, very disruptive and very painful for the incumbent government. Of
Yeah, I
course,
think
the
there
central
might
bank needs
be
to do what they need to do, and they're independent and fine. If there's 100% uh, uh, case for rate rises, and even us are turning around and saying yes, we need rate rises, then sure, deliver them. But when it's up in the air and it's not 100% needed, why wouldn't you just hold off until a deck? There's no panic, there's no rush. Just
yeah,
wait.
I feel there's gonna be some hints in public statements from one independent organization to
To
another.
another, yeah, that's right.
All brown envelopes under park benches.
Yeah.
Well, Jared, that's been really interesting, and we really appreciate your I guess candid comments, both here but also out in the market. I think it's really good to get people who are not scared to sort of tell it how it is rather than just following the herd, and that's how we like to think about things, and getting your comments around that, but also just the wider state of the New Zealand economy, and actually the positivity of some of the things that can come out of it if we do things more properly, and think about more longer term decisions. Then actually there's some really good things that can happen, and as you said, those 3 things that we could, that are easily achievable, the New Zealand economy will be humming, and so we look forward to those times again. So thank you very much for coming on.
Brilliant. I just wanted to add one thing. If you're listening and you're thinking about your bond portfolio, which many of us hold, whether it's with NZ funds or outside of the firm, please feel free to contact your financial advisor or NZ funds representative who you work with. Otherwise, we are always available for a review or a complimentary conversation. Email info@nzfunds.co.nz or give us a bell on 0800 377 2277, and we'll point you in the right direction and have someone get in touch with you very quickly. Thank you, Jarrod. It was a great conversation, and we look forward to speaking to you soon, probably in a more positive environment. It won't be too far away.
Hopefully.
Okay, great. Have a good one. Have a
Cheers.
great week, everyone.
Take care.
New Zealand Funds Management Limited is the issuer of the NZ Funds Active Income Series, NZ Funds Active Inflation Series and NZ Funds Active Growth Series, together the NZ Funds Active Series, as well as the NZ Funds KiwiSaver Scheme, the NZ Funds Managed Superannuation Service, NZ Funds Wealth Builder and NZ Funds Income Generator. For further information or to request a copy of the product disclosure statement for each of these, please contact NZ Funds or visit nzfunds.co.nz. This recording is provided for information purposes only. The information provided is not intended as a substitute for specific professional advice on investments, financial planning, or any other matter. Past performance is not an indication of future returns.